So your quasi-government actually is looking to make the misinformation in real estate news worse, not better. How can that possibly happen? Let's get into the real estate market. I'm Bill Gross, the LA Probate expert, and this is my weekly real estate market update. Just a real quick update on where the market is. Overall, good news is interest rates have stayed low with all the international meltdown in cryptocurrencies and stock market volatility. You can see that for the last week, interest rates have been steady at 6.6%. They dropped down below 7.25 as people fled cryptocurrencies. One place they looked to invest was U.S. mortgage bonds as well as real estate. And so that's been seen as a stable place to be in an otherwise turbulent ocean. What's interesting is notice the Freddie Mac survey, the green one, dramatically, which has always been a little higher, dropped down below to about where the real market is. The real market is what you can buy a mortgage for if you lock in today. That's the real market, like a stock price. And the government and lenders and advertisers pretend as though the market's some volatile, nebulous thing. The reality is it's like stocks. There's a price for Apple stock. There's a price for Tesla stock. There's a price for a mortgage. And for some reason, your government wants to lie to you about that. We'll get into that in just a second. What's happening with the housing market overall? Redfin has a great source of data. You'll notice that year over year, median prices have come down since the peak in September. We were over $400,000, now down to about $357,000, still above the year. In fact, we're 2.8% year over year. So when somebody says prices have dropped, it's true. Like in many years, prices peaked in July in the summertime and are lower now, but we still have an increase for all the negative talk and all the global craziness going on in the world, wars and interest rates and cryptocurrency. Housing prices remain above where they were when the year started. They remain above where they were last year, and they remain above where they were 2 years ago. Let's break down a little further. I have people say all the time, oh, I see housing prices have dropped, 25% or 20%. Well, not really. Asking prices went from 400,000 down to 369 on average. So the asking price gap has moved. You can see the gap has gotten bigger than in years past where it stayed fairly stable. But that's just the asking price to the actual sales price. It doesn't mean the price of the house went down. It means the seller was asking for a price that didn't make sense, acknowledged that, lowered the price. That's what it sold for. If you look at the payments, though, this is the real challenge, is that housing payments are higher than they were a year ago by 42%. That's a big challenge in our industry. Pending sales have dropped tremendously below the last 2 years. New listings have declined, which means that sellers don't need to sell. They're just not maybe trading up and moving like they did during the pandemic overall. And then you look at the average listings, how many are active. Again, more than last year, not as many as the year before. Still, by historical standards, a very low level of listings available for sale. And I just want to tell you, whenever you hear somebody say that a normal market is 5 months of supply, that's crazy. That was true in 1970, 1980. That's like when I went to the market in those days. The market had one whole row of Hunt's tomato paste with like 200 cans. Now they have like 5 of everything, and they restock every couple times during the day at a minimum, so if not every day. So the inventory in all of our businesses has gotten shorter as technology has gotten better. It makes sense in housing as well. A house in the market for 5 months isn't normal. A house in the market more than 30 days at that price is already on the market too long and overpriced. We know that. So the housing market, the inventory has gone up a bit over the last 2 pandemic years, but it's still low by historical standards. And here's an interesting stat. 33% of pending sales are under contract within 2 weeks. So a third of the properties still go under contract within the first 2 weeks of going on the market, as down from maybe 45% last year and maybe 40% the year before, but still a phenomenal rate from a historical standard. The median median days on market is 35 days. Again, a little higher, but traditionally in the fall, things do slow down. That's kind of normal. And then selling above the asking price, even with the challenges, 27 homes sell at or above the list price. Now, normally that number is about 20%, 1 in 5, but still less than last year and the year before, but still 27% are selling at or above the list price. And of course, now, yes, many more have price drops, but it's only 7%, 7.6% of the whole, more than the last 2 years where we didn't have price drops. There are agents who've been in the business 3 years, never dropped a price of property in their career, but that's a normal part of the market. So that's the overall in the market. Now, let's talk about the latest culprit who's lying to you about the real estate market. It's your quasi-government, Freddie Mac. What do I mean by that? Well, Freddie Mac is a quasi-government agency in that the government owns some of the stock and the rest is owned by shareholders, stocks, banks, or something. Nobody really knows. I mean, I'm sure there's a legal answer what the real answer is, but it's kept kind of nebulous. It acts like a government, but it's not a government. To me, most of the government these days is too cozy with the industries are supposed to regulate. Look at the cryptocurrency. Here we have a guy who has the biggest Ponzi scheme in history, and now on surfacing our selfies of him with the government regulators, right? They're being paid to protect us. Meanwhile, they're getting paid off while the customers are being fleeced. Freddie Mac is kind of like that. In some regards, they're supposed to, being a quasi-government agency looking out for the government's interests, which should be the citizens. But in reality, it's more of an industry watchdog or industry shill. And throughout history, if you look at the rates of the surveys, for example, we have a Freddie Mac survey that comes out every week. We have an MBA, Mortgage Bankers Association survey comes out every week. And then Mortgage News Daily tracks the real rate, which is funny to say because you think they'd all have the real rate. But one thing you'll notice is the Freddie Mac rate is always trailing. When the market goes up, they're the last to go up. And then when the market comes down, they're the last to come down. Take a look at this. They trailed all the way up. And then on the way down, they trailed all the way down. So the Freddie Mac rate has always been, of all the indices, the worst. Now you'd think the government would have the best because the lenders are buying the mortgages from Freddie Mac. Freddie Mac is saying the market buying the bulks of mortgages as security. So they should know the price. So how do they do this? Well, they just changed it, as a matter of fact. They're going to go from bad to worse. As of yesterday, in fact, they're enhancing their survey. This is just too funny. So since, they have the data here, since 1971, what they used to tell you was the market rate. How they do that was they had a survey of lenders. They would send out a survey weekly. They would pick different lenders, and some would respond and some wouldn't. Well, I'm sure the ones that were busy and serving their customers were too busy to respond to surveys, and the ones that were overcharging customers were glad to share the rates. So it used to be a survey. Now, Freddie Mac in this paper describes the new process is their actual data, meaning when a loan officer gets a loan application from a customer and uploads it into the Freddie Mac underwriting system, it has a rate on there. And they have the data. Imagine that. They have the actual data for loan applications. Now, they could use the date of the day when it is first submitted. They could put the date in there when the rate's locked. They could put the date of the date when the rate is closed, when the customer experiences the actual rate. We know that's true. They chose to take it at the application, which to me is crazy because people will often shop 6 months, a year, 2 years for a property. The rate they're getting then is not related to what they're going to end up with. More importantly, as a former loan officer, it's good practice to submit your loan at a higher rate. Why? Well, think about it. If you're shopping for a house today and you qualify barely at 6.75%, and your loan officer puts the deal in at 6.75, and the rates go to 7, right? Now they have to go back to the underwriter and re-underwrite your file at that higher rate. But if they initially underwrite your file at 7%, even if rates go up, you're already approved theoretically at that higher rate. And so a smart loan officer will almost always leave 0.5% or 1% in volatile times to know they're already approved and tell the customer, hey, we're not locked in at that rate. I'm just using this to underwrite. Freddie Mac, in its infinite wisdom, decides to use the rate when you read the methodology that's submitted by the loan officer at the time that the file is initially submitted, which to me makes no sense at all. So as a result, you're going to now get applications from customers that may or may not be buying houses at that time. And they may not be ready to lock in the rate at that time. And so what all this really is what the loan officers are quoting customers in mass, which I think gives cover when the Freddie Mac survey is the one that's being publicized. And again, I don't know why websites don't put the real market rate in. They use the Freddie Mac survey rate. Why would they do that? Well, one answer is it gives cover to lenders to overcharge their customer because they can say the rate's higher than it really is and get away with it versus telling them the real rate. And that's the bottom line of all the data. Now, more interesting is when you break down their methodology, they break out a very interesting statistic. And I just wanted to share this with you. This statistic, wrong one. This statistic, Where was it? I was here. I'm sorry. This statistic shows borrowers paying extra points called discount points versus those that are not. Now, theoretically, when you pay extra points called discount points, is to lower the rate. It's a discount of the interest rate in exchange for the point you pay. And generally, you pay about 1 point of the loan amount. So on a $500,000 loan, you pay 1% or $5,000 extra to lower the rate by 0.25% from maybe 6.75 to 6.5%. But this is fascinating. According to Freddie Mac statistics, borrower paid points from 2018, 19, 20, 21, and borrowers did not pay points. The numbers are almost identical. Meaning, based on statistics, almost all the time, that lenders charge discount points, the customer does not experience a better rate. Fascinating. Fascinating. There it is in their data. So now it's one thing if you're going to get those discount points and use it to buy down temporarily your interest rate. That's great. That's not what we're talking about. That's not subsidy points. These are discount points used. And this is keeping constant, they said at least in their survey, things like cash out versus purchases and credit scores. Absolutely amazing. So your government is like giving cover to lenders to create confusion so customers don't know the right price instead of using its data and its expertise to help guide consumers in the marketplace to the right information. To me, it's inexcusable. So once again, this is Freddie Mac. And then in turn, this data is released to every major publication website, which uses this, I think, to mislead buyers along the way. So what do you do on mortgages? Work with a reputable lender. You know, when you go online to some of these Lending Tree and some of these collective services, it's like a liar's poker game there with 15 lenders and the one who lies gets the most leads. You want to work with somebody who consistently gives customers great value, meaning great service and at a great price. And so I tell them, let's get your contract approved, work with a great lender, get approved, and make sure they're competitive when you lock in. And at that time, you're going to give yourself both great service and a great price. So if I can help you, call, text, or email me. I'm Bill Gross, EXP on social media. My phone number's down below. Look forward to helping you any way I can. As always, make today your best day ever. Thanks so much.